Good evening, class. So tonight we're going to delve into Chapter 7, which is Finance and Mortgages. This is part of your finance segment. And so what I'm going to do, I will be talking about the real estate cycle in class live. So I'm going to jump over to financing procedure under 7-3 in your book for those that have the book. So we're going to learn a little bit about finance tonight, and I got to warn you, it's very dry. It's very dry when I teach it as well, but we'll get through it. So right on over to financing procedure, and as it says here in our outline, many buyers need to borrow. They don't have the money. They're not cash buyers, right? So they have to go and finance the purchase of their homes or purchase of their real estate. So often it's good to stay up on the rates with potential lenders, and you as a real estate agent out in the market will have contacts with loan officers. So you'll be steering them in the right direction and you'll be helping them along the way. So what is the first step in obtaining some financing? Well, the borrower has to go and fill out an application with the bank. And that application is going to be basically a worksheet for the loan officer to ensure that the buyer has the ability to afford this mortgage that they're about to get. So it may or may not be signed prior to the purchase and sale agreement. Usually, the buyers meet with mortgage brokers or lenders, okay, to complete this application. And so the application, not only is it going to be a worksheet working up numbers, but it's also going to take into account the buyer's background, their employment. So a lot of information is actually shown in this application, and it's sort of a summary on the buyer. Is the best way to explain it. It's going to show the buyer's employment, the buyer's income, the buyer's debts that are out there that might need to be paid prior to closing. It's also going to show the buyer's assets, what they have saved and their investments. All right, so that's a loan application. And so then the bank will go into its approval cycle, and it usually has two steps, as you see in the outline here. First of all, the bank has to approve a property. And then second of all, the bank, of course, has to approve the buyer or the borrower. Now, sometimes the lenders nowadays are able to just look at the borrower and do a lot of what we say underwriting on the borrower prior to the borrower finding a property. But in essence, for purposes of learning, the bank has to approve both the property and the borrower. Okay? And then the next chapter we'll be going over, or actually the chapter before chapter 7 that we would have gone over at this point, is on appraisal. So the appraisal is usually completed prior to the mortgage commitment, and it's prior to the mortgage commitment being issued. Credit report is pulled. Commitment letter will state the terms of the loan. So with the approval of the person and the commitment to the loan, what the bank is in essence doing at that point is the bank is committing to the loan and committing to giving the borrower the funds at the time of closing. Okay? So, and that usually goes hand in hand with the purchase and sale financing clause. The financing clause is contained in the purchase and sale. We dealt with the purchase and sale back in the segment which dealt with contracts, and we reviewed an actual purchase and sale agreement. The financing clause is part of that. Okay? So when a borrower borrows money, there are basically three major documents they sign. The first is a closing disclosure statement, which is basically like an accountant's spreadsheet. And then the other two documents that I always go over first with the borrowers at any closing is the promissory note and the promissory deed. I'm sorry, the the mortgage note and the mortgage deed. Um, the mortgage note actually is the promissory note, as I just mentioned, and that is the personal promise between the borrower or the mortgagor and the bank or the mortgagee. So when you're thinking about a lender moving forward, if you see the word mortgagee bank is what you want to think. As I mentioned before in other segments, when you have a word that ends in double EE, that usually is the recipient of the right, and the one that's giving the right is usually the word ending in OR, the OR word. Well, in this instance, the borrower is giving a mortgage to the bank. So the bank is the mortgagee, the borrower is the mortgagor. And so the borrower will sign a promissory note, okay? And that's a personal promise between the bank and the borrower, and it states the terms of the loan. The borrower will also be signing a mortgage deed. And as they say in Massachusetts, a mortgage is a temporary conveyance of the title of the real estate to the bank until the mortgage is paid, or until the debt is paid, until it's fully satisfied. So they call it a mortgage deed, but in essence, it's the mortgage. That's the mortgage. And that's what gets recorded at the registry of deeds, and that's what the bank uses to secure its interest against the property. All right? So the borrower signs a promissory note, the borrower signs a mortgage. All right, on we go to lending institutions and money. So interest rates will change daily. The prime rate is the rate which the lending institution will charge its best customers for short-term loans. The federal discount rate is the rate charged by Federal Reserve Bank to its member banks. So it's one bank to another. That's the rate that's being charged as a federal discount rate. And so then we move on to the types of lending institutions that are out there. The first one we go over is the savings and loan associations. These institutions are set up to deal with long-term lending requirements for real estate. They must be chartered by the state or federal government and are governed by the Federal Home Loan Bank Board. They will insure deposited funds through the Federal Savings and Loan Insurance Corporation, or FSLIC. Okay, as it says here, up to $100,000. And then the next type of institution you have is a commercial bank. Most of these types of banks extend short-term loans, checking, auto and personal loans, home improvements. They help keep the bank liquid. A large amount of deposits are on demand, so the bank can call the note when it sees it fit to do so. And they're required to be chartered by the state and federal government and will be insured through the FDIC. Okay? The next institution is mutual savings banks. There is no stock issued, and it's owned by the depositors. These types of banks are owned by the depositors. And they're similar to savings and loan associations. They prefer more stable real estate loans, such as conventional FHA and VA loans, and they are insured by the FDIC. On we go to cooperative banks. A cooperative bank considers its depositors as shareholders. That's the difference here. It's almost like they're investors in the bank, okay? Shareholders are investors. The members can deposit money and buy shares in different increments. The loans are made to the shareholders. And then there are credit unions, which is created by members of corporations, associations, or other organizations for its members' benefits. Okay? So credit unions are usually formed by, let's say, for instance, it's a teachers union, right? Or the police union. They will form credit unions. They're considered cooperative by nature. The member deposits funds in accounts with better than average rates. Then there are mortgage companies, which they're still in existence, but they're not as dominant as they were in the past prior to the crash. And brokers will originate. So it's almost like having an insurance agent, right? A broker is almost like an insurance agent. They'll go out and find the deep pocket. So brokers will originate the loans on the real estate for other lenders, for the deep pockets out there, for the bigger banks. Mortgages are placed on the property and then serviced by the mortgage company for a fee, or they may be serviced by the larger bank. But the thing to remember with mortgage companies is they are the originators of the loan, and then they sometimes will pass off servicing to a bigger bank. Life insurance companies, these organizations that lend money for premiums, usually on large commercial business ventures. And then you've got private lenders, private investors who are willing to loan funds provided they are secured by real estate. These investors will act like a bank in loaning money. It may be for a first or a junior position, and oftentimes they charge a higher interest rate. In this instance, if let's say for instance, a seller says to a buyer, look, you give me $25,000 in cash, and then I will give you a loan for the purchase of my home. So in essence, the seller's not getting much money. They're mostly taking back paper, as we say. And that's what this term is all about, taking back a mortgage. The seller's not getting money, they're taking back a mortgage, taking back paper. Okay, so those are the types of institutions that are out there. Now we're going to talk a little bit about the types of mortgages that are out there. The first one we've got is a conventional mortgage. A conventional mortgage is a mortgage with no guarantees or insurance from the federal government. The buyer applies and the bank agrees to loan the money. There's no insurance, right? So mortgage insurance, depending on the amount of the loan. And then there's the veterans, the VA mortgage. It's also known as the GI mortgage. It's for a vet to be eligible, they must obtain a certificate of eligibility through the Veterans Administration. The Veterans Administration guarantees the loan to the bank in the event of foreclosure. So there's no insurance on these loans, folks. The Veterans Administration guarantees the loan to the bank. The bank makes the loan, not the VA. The VA only guarantees the loan to the bank should the veteran go into default. And as it says here, it goes a little further, the property also needs to qualify for the program. It must be owner-occupied, a 1 to 4 unit dwelling, which has obtained a certificate of reasonable value through the VA appraisal process and pass a termite inspection. And similar to the VA is the FHA program. FHA is the Federal Housing Administration. It was established as part of the National Housing Act and is now a branch of the Department of Housing and Urban Development. The mortgage was established as a means to stimulate the housing market and to protect lenders against default. The FHA program insures the loan rather than guarantees it. So this is now insurance. It's called mortgage insurance, or PMI, private mortgage insurance. For insurance policy, the borrower must pay 0.5% of the average annual balance of the loan as an insurance premium. So those are insured programs. Mortgage insurance usually exists on the program as long as the borrower remains in the program. It doesn't get dropped, in other words. There's the MGIC. The Mortgage Guarantee Investment Corporation is one of several private mortgage insuring companies that modeled themselves after the VA and FHA programs. The lender applies the money to the borrower, or supplies the money to the borrower. The borrower pays a slightly higher than average interest rate. The bank sells some of its risk to GMIC. The advantages over FHA and VA paperwork between a borrower and the broker or the lender is minimized. So most of your loans that are out there are a direct reduction mortgage. The total monthly payment of principal and interest combined remains constant throughout the life of the loan. at the beginning, the interest payment is much higher, but as time goes on, the ratio shifts between interest and principal, and then the principal becomes much higher. So the person pays the same, well, and we'll be going over this in class as well, but the person pays the same monthly mortgage payment, and then what gets applied to the principal grows over time. So at the end of the table, which is usually 30 years, the balance is at zero. Then there's a construction mortgage. The money is advanced to the builder in partial payments based on a schedule that the contractor submits to the bank. Portions of money will go out to the contractor, right? The bank is not going to give the contractor a lump sum payoff, because a lot of times what happens is the contractor will disappear. So payments are made as stages are hit, as it says here. What's a blanket mortgage? Now, a blanket mortgage covers two or more pieces of parcels of property or pieces of property, which are offered by the borrower. And so for an example that I usually give to the class, let's say a seller wants to sell their house and buy another house, but the seller doesn't have a buyer for the seller's house yet, right? So the sale can't happen. What will happen is the bank will extend a blanket mortgage over the property that the seller is selling and the property the seller is buying on the other side. And then once that seller's property is sold, the money goes up to the bank, that portion of the mortgage is paid off, and then there's a smaller mortgage that remains on the seller's new home. That's a blanket mortgage. It covers more than one property. A purchase money mortgage is basically any mortgage that is taken to purchase a piece of real estate. But as I say here in the book, the buyer does not have sufficient funds to pay the agreed sale price for the piece of property, including the money from the bank. The seller will extend credit and record a first mortgage on the property. So once again, in this instance, the seller is taking back paper. But I apply this term purchase money mortgage basically to any mortgage that is taken to purchase a piece of real estate. A junior mortgage is any mortgage that does not have first priority or first claim to the piece of property. So in Massachusetts, it's first in time. When it comes to recording at the Registry of Deeds, it's first in time, first in right. So if the first mortgage goes on and then a second mortgage goes on after the fact, the first mortgage has first priority to foreclose on the property if the borrower defaults. The junior mortgage has second priority. So if there's anything left over after the foreclosure, the junior mortgage gets paid. If there's nothing left over after a property is foreclosed, the junior mortgage is wiped out. An open-ended mortgage, the approved loan amount is not taken by the borrower all at once, right? So they take only a portion of their money that they're borrowing and they save the rest for later. Okay, and so the borrower is only charged interest on the amount borrowed or the amount taken, the amount used. Okay, a wraparound mortgage, the seller is also becomes the lender in this one. The payments from the new mortgage usually are larger, and the amount a larger in amount and the higher interest rate, and will be used to service the existing debt still secured by the property. So basically what happens here, in Massachusetts, well, right across the board, these types of mortgages are not allowed. The seller owns the piece of property. They have a mortgage on the property. The seller extends a mortgage to the borrower or to the buyer, and that mortgage payment is higher than what the seller makes to their present mortgage. So the seller sells the property to the buyer, and the mortgage from the seller remains on the property. And so the buyer makes the payment to the seller pays the existing bank. And so the buyer is going to pay a higher mortgage payment to the seller so that the seller can make a little money and then pay off the mortgage. These types of mortgages are a direct violation of, as you're going to see in the book here, they're a direct violation of the due on transfer clause in every mortgage. And so therefore, if the seller does not pay off at the existing mortgage that the seller has, that bank can foreclose. Wraparound mortgages are basically not allowed. It violates the law. Variable rate mortgage allows the borrower to finance the property at a lower than average fixed rate in the beginning. Then as time goes on, the interest rate will change. In most instances, that interest rate will increase. It'll go up over time. They call a variable rate mortgage also an ARM. All right, so if you hear in a test question a 5-in-1 ARM, that means that the interest is locked for the first 5 years, 5 and then 1. After the first change, after 5 years, the rate is subject to change every year thereafter. So locked in for the first 5 years, then every year thereafter, it's subject to change again. So 5-in-1. ARM just means an adjustable rate mortgage. Okay, that's all it stands for. A balloon mortgage. A balloon mortgage is one that culminates with a final payment which is larger than any of the preceding payments. So the way I usually explain this one to class is the bank will spread out your payments over a 30-year period. But then the bank will say, but your actual maturity date, the date that everything is due, will be 20 years. So you'll have a 30-year table, and you'll be paying your mortgage as if you're paying it off in 30 years. But in year 20, you're going to owe all of it. So the idea is you spread it out over time to lower the payments. But in year 20, the full payment is due, whatever's left, right? The last 10 years. So the idea for the borrower is you're going to refinance before you hit year 20. Okay, that's a balloon mortgage. Balloon payment at the end. A shared equity mortgage, I've never seen one of these, but the borrower and the bank agree to share the increase in value of the subject property, in contrast to an owner receiving the benefit of the increase in value of the property. Typically what happens is if the properties go up in value, the borrower benefits from that, not the bank. The bank is still owed their money. A negative amortization mortgage is one where the monthly payment agreed to does not cover the interest charge. So what I was seeing with these in the past was the bank said, oh, we have a wonderful program to the borrower, Mr. Borrower, to put you on. You only have to pay 2% for the first 5 years. And that sounds too good to be true because it is too good to be true. In actuality, the borrower was being charged, let's say 5%, and the bank said all you need to do is pay 2% for the first 5 years. Well, the extra 3%, because the interest rate is actually 5%, is being tacked onto the principal in the background every month for 5 years. So by the time the borrower gets to year 5, the loan recalculates to interest and principal and interest payments. And when that happens, the principal has grown over 5 years because there's 3% being tacked on to the principal every year. And all the borrower was paying was 2%. So that's a negative amortization because what happens in that loan is the principal grows in the background. It doesn't shrink. So it's a negative am. A package mortgage, this allows the borrower to finance not only the real estate, but usually items considered as personal property. Probably see these mostly with business loans, right? The business is buying a piece of property and they have equipment. Bank is going to pretty much file an interest against the real estate and the equipment of the business. Demand or call mortgage. The lender has a right to call this note due and payable at their discretion. That's usually a commercial setting. Mortgage buy down. The buyer or seller will pay the lending institution an amount of money up front to decrease the monthly payments. So the more you can put down on a mortgage up front, the lower your payments will be in the future. And so that's what a buy down is. Okay, and I saw this quite a bit when the market was starting to recover. The sellers were offering the buy down option to buyers when they came in the door. They said, we'll give your bank another $2,500 prior to closing so that we can buy down your rate for you. So it says the amount of the buy down is usually based in part on the present value of the loss the bank will incur because of the lower than normal monthly payments they will receive. Okay. Home equity loan. This type of loan gives the borrower an open line of credit. It's like a glorified credit card, as I say, with the bank. The max that can be borrowed is no more than 75 or 80% of the value of the property. So it's an open line of credit. The way it used to work was the borrower would get a checkbook. The borrower could issue checks. Let's say they were doing a project on the house, they could issue checks. That's a home equity line of credit. What's a point? So we just actually went through 7.4, 7.5 to 7.7 of your book. Okay. Actually, we covered most of the chapter just on that alone, because we talked 7.7 through 7.11, the types of loans that are out there. Okay. And now there are other concepts that are being talked about in the book on 7.12. So we will cover those in class, but I did want to get through the types of mortgages and the types of lending institutions that are out there. I hope that you enjoyed this segment. It's really dry. I do apologize for it. Do look at your outline. Do read the chapter, and we'll be going over it in class as well. Okay? I thank you for your time, and I'll see you in the next segment.